Well, an extremely interesting note coming in from Jefferies, and Mahesh Nandurkar of Jefferies has written on what he calls the preferred yield gap that they look at. He says that the valuations on the preferred yield gap, which is the bond yield minus the earnings yield at this point of time, has surged to a high of almost 165 basis points. And he says over the last 10 years, Nifty has traded at these levels or above 25% of the time, and the average 12-month return has actually been quite negative. So they're turning quite cautious. They're turning at this point of time extremely selective when it comes to sector rotation or stock, that they're picking, and also the model portfolio. A certain amount of changes has come through. What they're saying is that they continue to remain bullish on the economic cycle. They believe the valuation cycle may actually play out quite differently. They are lowering the model portfolio beta by actually moving some weight from Jubilant, Tata Steel and ICICI Bank, and they are adding it into Maruti, Eicher Motors and HDFC Bank. So from the outperformance from the high beta stocks that have significantly outperformed, they believe that there can be a certain amount of correction or a certain amount of underperformance due to the high valuations, and they are finding more comfort in names that offer both valuation comfort as well as a comparative underperformance versus the markets. Now what they are saying is that a check of the Nifty 100 stocks on valuation shows that only 28 to 26% of stocks are actually lower than their 5 to 10 year average. They find autos and financials to be better placed on the context of valuations, and they believe relative valuations amongst the private sectors, they believe autos and financials look better. They are reducing weight as mentioned on ICICI Bank, Tata Steel. They remove Jubilant Footworks from the model portfolio, and all of this headroom that they have received, they have added to HDFC Bank, Maruti and Eicher Motors. What they are saying is that as far as the model portfolio stance is concerned, they continue to retain their overweight stance on real estate. They believe that the sector has likely entered a long-term upcycle, which has the potential to actually go ahead and do much better. So at this point of time, when you are looking at what Jefferies has to say, it's quite evident that Jefferies and Mahesh Nandurkar at this point of time actually are quite cautious, and they're looking at the market with a tinge of caution, given the fact that valuations as well as the gap between the bond yields and the earnings yield has actually hit historically high levels. So at this point of time, they're not finding too much comfort at high valuation and high price stocks. But yes, of course, they believe that autos and financials can do better going forward.